Hey everyone. Today I wanted to talk about how companies create an internal stock market within their business. And I'm talking about large capitalization companies here. So if we look at the publicly listed markets, right, like the S&P 500, the ASX, in Australia, for example, where I am, you have companies like Woodside, BHP, banks like ANZ, Commonwealth, etc. Right, as well as your mid-cap companies and IPOs and other securities on there as well that the public can kind of invest their money into based on their risk to reward appetite. And I wanted to talk to you guys about in this video how internally within large capitalization companies, your management team and your shareholders, the board, they want to create this similar ability, mirror this ability that exists in the public markets, right? And this is namely around projects. So I work, in energy company. My background is in engineering and econ and finance. So I've worked in both capacities. I've worked in a engineering capacity, and I've also worked in the economic space as well within the energy sector. And the typical way in which an energy company works is that they will own assets, right? And in this context, these assets are typically large infrastructure builds, right? So things like wells, power plants, process plants for hydrocarbons, right? And you can imagine that if you're a company that owns these assets, you would have a lot of operations and maintenance and as well as optimization that you would have to do of these assets, right? So the way in which decisions are made in this environment is that your projects get broken up into, your works or your initiatives get broken up into projects that have set parameters that kind of value what that project is. And these parameters are typically NPV, so net present value. Then you have your PI, which is your profitability index, and then you have your payback period as well. And there's a few other parameters in play as well, but for the sake of simplicity, we'll just talk about these three, right? So NPV obviously is net present value, which is essentially taking in your capital input, your operating input, and then your cash flows, and then generating a net present value, right? In simple terms. And then your profitability index is your NPV divided by costs that you care about, right? And then your payback period is how long it takes to break even. And so with these three parameters, right, your executive team will make the decisions on which projects that they should go forward with. So let's say we take an example of three projects, right? So you have project A, which might be to build a pipeline infrastructure between two process plants, right, to debottleneck, let's say, hydrocarbon flow. Right. Your next project might be that your res team have told you that this geographical location that's within your tenure has promising reserves, and you might be considering, or the executive team might be considering, okay, let's build new wells to be able to tap into those reserves. And then project C might be, okay, we have these process plants, but we need to upgrade or upgrade a component on these process plants, right? To either optimize their performance. And so you would think from the perspective of what the information you've been giving, the decision would largely fall on an engineering capacity, right? And it does to some degree, but the wider business strategy is actually based on what is your similar risk to return that you have in your public equity markets, right? So your investment team would look at, okay, based on what is my risk to return of these different projects, which are the most valuable projects. And then you also have the idea of options as well. So similar into the financial markets, you have financial options like swaps, puts and calls, right, alongside others as well. And in the project world, you have the ability to, have options to delay a project. Is a project contingent on other projects? Can we pull out of a project at certain points, right? Those things add the ability to influence the value of the decisions that you make as well. And then you would also consider your capital structure as well, right? So you might think about, okay, so you want to fund or allocate capital towards this particular project, but let's say you want to have a 50-60 or whatever, sorry, a 50-50 or a 60-40 ratio of equity to debt, right? But then you might consider, oh, okay, this project has particular risk profiles that our creditors don't like. For example, banks will, they will want to know what is the nature of the project that you're doing, because if the project fails and you default, then they might not like the idea of actually owning these new assets that you have, because they don't have the expertise to be able to operate them. And so you can really see how in large capitalization companies it becomes its own ecosystem, right? And it gets very complex, and there are a lot of cogs turning. And ultimately, however, they want to create an environment that mimics a portfolio, where you can have risk to reward preferences, and diversification as well. So that's essentially all I want to talk about for today's video. If you found that insightful, if you have similar insights to share, and if you got anything out of it, please feel free to like and subscribe and comment down below as well. Cheers.